Welcome back to the channel. My name is Andrew. Man, last week was crazy, especially on Thursday and Friday after the market was trying to price in tariffs. S&P 500 closed week down 8.12%, Russell 2000 small caps was down 8.24%, and QQQ was down whopping 8.50% in a single week. The fear and greed index at 4, the level of extreme fear. VIX is spiking 88% to 45 points. Today, Warren Buffett's famous quote, "Buy when others are fearful," is as relevant as never before. In this video, I will show the watch list of highest quality stocks that I'm planning to buy as market is crashing. And if you want to join the best investing community in the world, the link for the Discord server in the description and pinned comment, it's absolutely free. Welcome to join. What's going on, investors? Hopefully guys are doing well out there. Now, some of these stocks I already own, some of these I wanted to own for a long time, but they were trading at too expensive valuation and I was waiting for the right price to buy. I will share with you 3 different categories of stocks. The first one is a core foundational stocks, large cap stocks with stable, predictable revenue and earnings growth, profitable but still growing and reinvesting back into the business. The second category is high growth stocks. I am still young, 32 years old. I am still in a stage of growing my capital, so I definitely want growth stocks. And finally, I will share a third list of stocks, dividend stocks. As the price of the share falls, dividend yield rises. And if we make sure that we pick solid companies with high margins, positive growing free cash flow and strong balance sheets, we can book a great yield and then enjoy the paychecks from these dividend stocks for a long time in the future. Okay, I think this is the intro for the video, and as I am sharing the list of the stocks, let me know in the comments if I'm missing some very high quality company in my watch list. I would appreciate it so much, as at difficult times like this, we have to be together and help each other to go through stronger and, most importantly, richer. As Warren Buffett once said, the stock market is a mechanism for transferring wealth from impatient to patient, meaning that those who are patient and hold investments during market downturns, like what we are having right now, can benefit from the wealth of those who panic and sell. Starting from the core foundational stock, and for me, the top one of the best company in the world, one of the company I always wish I own, is Microsoft. Microsoft has significant amount of revenue as a recurring revenue. Microsoft is top 2 in cloud computing. A lot of products people will never cancel and just cannot live without them. Microsoft charts is as good as it gets. This is as smooth as it gets, and every dip in Microsoft stock was the buying opportunity. Here in 2021, 2022 was the buying opportunity, and right now we can see there is already a dip, and Microsoft cooled down from almost $450 per share to right now $360 per share. Microsoft at $450 was expensive, but right now, after cooling down to $360, I believe Microsoft is a buy right now, but we can start building the position. So for example, if you want to buy 10 shares, you can buy 1 share right now, and if Microsoft is going to retest here at a previous all-time high at $136 per share, you can continue dollar cost averaging, because for the Microsoft, for the long term, this is already very good prices, and for the all time, you can see this is as smooth chart as it gets. As I mentioned, very predictable, smooth, and still very fast growing company, foundational stock for every portfolio. The second company in the list is Amazon. For the Amazon, the chart is a little bit more volatile than Microsoft, but this is the top 1 company by market share in the cloud computing. I am very bullish about the cloud computing, and I believe that hyperscalers will be having a business model like renting the space for clients in the future, because in the future you need more and more capacity, and these 3 hyperscalers, Microsoft, Amazon and Google will just keep splitting this market. Amazon is already my largest position in my portfolio, north of 26% of the portfolio, but I would like to add more shares. So on the retesting of previous all-time high at around 175, I already had a alarm in TradingView, and this alarm actually was triggered as Amazon hit 165, something like this, in Friday. So I already bought some more Amazon for my portfolio, and if it continues to goes down, and if it goes to some ridiculous level like 84 where it was in December 22, I definitely would want to own more Amazon, because I believe that Amazon in 5 years will be significantly higher than right now. My main investing thesis about Amazon is that I believe that retail margins will go significantly up because of robotics and optimization. The third company in the list is Google. I would say this is the weakest company for the foundational core stocks, because for the Microsoft we have a recurring business model, very stable business model, recession, no recession. Microsoft does not care. Microsoft will grow regardless. So the only problem about Microsoft was the valuation, which now is cooling down. For Amazon, the risk is that if we are going to recession, people will spend less money online, which means that less revenue for Amazon and also less advertising dollars, because advertisers will cut their expenses first. The first expense will be cut from the companies is marketing, sales and marketing, and this is the problem for advertising company, and advertising business for Amazon is already very large. For Google, before, the significant part of Google's revenue was advertising, but right now Google is diversifying, and Google's cloud division is already growing and it's profitable, and they have a search business, and they have a YouTube business, and also they have Waymo business. Waymo is expanding rapidly and are already operating in multiple cities in United States. So I believe that Google is becoming more and more diversified. But if we're talking about the foundational stocks, I believe that Microsoft and Amazon are stronger, and Google, because the price for the Google is very, very cheap. If you watch the Google's valuation is basically like 10, almost near 10 years lows. So the Google is very attractive already from the valuation perspective and also from the technical level. So from perspective of the technical retest of previous all-time high, this is as beautiful as it gets, and in the future we will see will Google continue to go down. But as I mentioned, I already own Google, and I would love to buy more shares if the market, if the Wall Street gives me the opportunity to buy Google under 100. I think this would be a ridiculous and generational buying opportunity. Coming to the second list, and this is a high growth stocks, starting from the CrowdStrike. CrowdStrike is a leader in cybersecurity. CrowdStrike was growing 30% for a long time in the past. This is just the beast of a company, and if you see the chart, this company provided significant returns to their investors. They have a big outage here, you can see this drop, but all this drop was totally recovered, and CrowdStrike was hitting all-time highs again. The free cash flow margins, even though a lot of free cash flow is coming from stock-based compensation, but in the future this will be less the case as for other software as a service companies. This is absolute leader in cybersecurity. They already are profitable, and they keep growing very fast. And from this outage we see that the churn was very low, which means that the clients did not really stop using CrowdStrike, which shows their value proposition and how strong their platform. The second company is Palantir. I was buying Palantir before in 2022, and I was averaging down in 2023, but I sold too early. I felt that Palantir became overpriced. I sold. I think this is the one of the best positioned company for the AI revolution, and this company was doing AI when the AI was not mainstream yet. I believe Palantir is very solid and strong and fast growing company. The problem of Palantir, when it was trading here at actually in the chart we did not see, but if I go to the 5 years chart, you can see here the Palantir was trading at 120. This is the totally ridiculous price, and even every Palantir bull was saying that valuation was stretched at that time. And right now Palantir is cooling down at $75 per share. If Palantir goes down at 60s, I would start opening the position, and a dollar cost averaging all the way. If it going to 40s, 30s and stuff, so on and so forth, I cannot promise it will go there, but I definitely from 60s, I definitely would like to open and start the position in Palantir. Robinhood is revolutionizing the brokerages business. This is obvious that they are taking market share from other brokerages, and I think young people is using Robinhood, and when they become elder, probably they will not exit their favorite platform. So I believe Robinhood is disruptor here. I would like to own Robinhood. I'm still doing research on that. Right now Robinhood is correcting, and if it's going lower, I will catch up with my research. I better understand the business model and better understand the moat around this business, and I will be able to start the position in Robinhood. Elf Beauty. Most of the people watching this channel is men, as I can see from the channel analytics, but everybody knows that most of the money spent in the economy is spent by women, and Elf Beauty is best positioned to capitalize on this trend. Women are spending significant amount of money on cosmetics, and Elf is very strong brand. And what I like from Elf, they are leveraging social platforms, TikTok, Instagram, Reels, and they have many viral videos where people are using their cosmetics and promoting this brand. Elf has significant correction, double top here at $200 per share, and now corrected all the way to 50. There is a scare on Wall Street that Elf is importing a lot of stuff from China. That's why they can make prices lower comparing to the competitors. But I believe that most of this is already priced in, and Elf is projecting revenue growth for north of 10%, and also the earnings growth. So I will do a little bit more research on Elf, and I will start position if that continues to drop. Meli, I already have Mercado Libre in my portfolio. Meli has a marketplace, Mercado Libre. This is the most popular marketplace in South America. Meli has Mercado Pago, digital wallet, Mercado Credito providing credit solutions for merchants and also customers. This is the South American Amazon. They also have advertising. The business model is very similar to the Amazon. All-time returns providing to investors is north of 6,500%. A lot of money made by investors in this stock. I believe that this stock is a stock to own, and this stock did not correct enough. So if this stock continues to correct, I will be adding more shares. The next company in the list is Hims and Hers Health. This is a disruptor in telehealth industry. They have hair loss solutions, skincare solutions, weight loss solutions. This company is growing very rapidly. This company was boosted by weight loss solutions and was growing close to triple digit in the latest quarter, 69%. I did a video about Hims, so if you want to learn more details how I believe that Hims could become a multi-bagger for your portfolio, please watch that video next on my channel. But I believe that Hims is definitely a opportunity here at $25 per share, and on Friday when Hims was hitting $25, I was selling puts for January 2026 and capitalizing, earning premiums for me to be able to buy the shares of Hims at $15 per share. So I think this is a no-brainer, and let's see how after the FDA deleted from short list the GLP-1, let's see what will happen with the growth rates of Hims, because this could be a risk factor. But I still believe in this company, and I believe that they have a lot of opportunities apart of the weight loss to grow in the future. If you like sharing me the companies in my watch list and why I believe this is the opportunity, make point of subscribing to this channel, because I'm looking to provide more and more value for you guys. Thank you so much, appreciate it so much, and let's move on. Tesla is very controversial stock. Some people think that Tesla is a car company, some people say that Tesla is a software and AI and robotics company. For me, I'm somewhere in the middle. I see that right now Tesla is generating most of its revenue from car business, from auto business, but also they have a energy business, and also we can already see that robotics, the result from robotics business is already coming this year. So that's why Tesla is definitely very high in my watch list, and I would definitely start to dollar cost averaging at this range. I think the Tesla under 200 can start dollar cost averaging, but this depends if you are investor which does not want to take risk. Probably Tesla is not for you, but for me, I just did not see much other places where I can capitalize on robotics. As I mentioned, for me, Amazon is my robotics bet, because I believe that robotics will improve significantly margins for Amazon retail business, but in terms of the company who will be building robots and selling robots to the consumer, of course Tesla will start leveraging robots in their factory first to improve the efficiency, performance, and stuff, and cutting expenses. But later in the future, Tesla will start selling these robots to the consumer. And for now, this is the one of the company which can on scale build significant amount of robots and capitalize on this opportunity. So for me, Tesla is of course one of the bet on robotics. The next company in the list is Nvidia. Nvidia was just a skyrocketing company in 2023 2024, right after ChatGPT came out. Nvidia is the leader in AI hardware, and right now they have a lot of software, and they are trying to build ecosystem and trying to build more and more recurring revenue. Maybe it's too early to say, but probably this cycle of semiconductors is finished, and probably Nvidia will, at the best case scenario, retest 90, and in the worst case scenario retest 40s here. So prepare for the ride, but I believe Nvidia is still a very good company, a leader in the industry. So at 90s it would be a buy, and dollar cost averaging all the way until 40. Another semiconductor company in the list is Broadcom. All hyperscalers is partnering with Broadcom to build its custom silicons for AI training. Broadcom has cybersecurity solution and networking solution. Broadcom delivered significant returns to investors, north of 8,000% returns. I wanted to own Broadcom. I'm still doing my research. The Broadcom is keeping crush. Probably Nvidia and Broadcom will be something similar because they're both in semiconductor sector, so probably their chart will be somewhat similar. The final third list is Dividend Stocks list, and the first company in this list is Visa. Visa is very solid company, and this is as smooth chart as it gets, probably even better than Microsoft chart. Visa has profit margins north of 50% and gross margins north of close to 100%. Absolutely mind-blowing company. And if you think about it, how tariffs can affect Visa, the problem is that tariffs is only a tailwind for Visa, because the tariffs will be inflationary, so inflation will push prices higher. But because mostly Visa business model is commission based, so the higher the price, the bigger the commission Visa is charging. So in this case, this is the tailwind. But another part of the coin is a headwind from the potential recession. If we're going into the recession, the consumer will cut spending, which means that they will buy less stuff online, which means less transactions from the Visa network. So this part is, I would say for Visa is relatively neutral. It's just Visa was quite high valued here at 360, and now Visa corrected all the way to 313. I believe under 300 Visa already will be a buy, and I was buying Visa when it was price to earnings less than 25, and then when Visa reached price to earnings 30, I sold it. And if Visa comes back to price to earnings 25, I will be able to open the position back. Visa provided significant returns to investors. Visa is buying back significant amount of shares, paying dividends, and this is the sleep well at night investment, and do not worry about nothing, because Visa will continue deliver returns for you. The next company in the list is Pepsi. Pepsi over the last 5 years provided just 10% returns, and of course over the long term provided 20,000% returns, but Pepsi is a quite old company. So right now Pepsi is correcting from almost $200 per share to 150, and we can see that somehow Pepsi is bottoming here. So I believe investors does not really want to continue selling this company. Here we already see higher highs, higher lows. Pepsi is a very strong company. It's not only about the drinks, it's also about the convenient food, chips, Doritos, Cheetos and stuff like this. I believe Pepsi is kind of a recession-proof company, because if you think about it, will people really drink less Pepsi or eat less Doritos if there is a recession? So I believe that Pepsi is kind of a recession-proof company, and of course some kind of spending could be cut, but not so much. So in this case, the only valuation of Pepsi is a risk, and right now valuation already cooled down. So I believe that Pepsi is a buy, probably here, could be starting the position, not financial advice of course, but and then dollar cost averaging as it goes lower. The next company in the list is Booking Holdings. I was amazed how the travel industry was experiencing significant inflation over the last 5 years, and even that, people keep spending, people keep traveling, people keep booking the flights and watching and experiencing emotions. I believe that travel companies are very well positioned. Booking's business model is very nice. Booking's business model contains advertising, contains commission based, contains recurring revenues. I believe that Booking is well positioned, and Booking start its correction from $5,300, and right now it's corrected to $4,200. I think it could go a little bit lower. Booking had a run from $2,200 per share, basically doubling to $5,200 per share. So I believe that probably it should correct maybe around 3,000. We can start opening the position and dollar in cost averaging to retest this previous all-time high. The next company in the list is Next Era Energy. Next Era Energy is well positioned for growth and taking market share as a one of the largest utility and one of the largest renewable energy in the United States. Next Era Energy is paying the dividend around the 3.4%, and as it continues to go lower, the dividend yield is increasing. And if the Next Era Energy provide us the opportunity to buy again at 50s, I would definitely take advantage to buy Next Era. And the last company in the list is Vici Properties. Vici Properties did not really correct so much, but this is a very strong company. Average leasing contract is north of 40 years, which provides a good predictability and shows how strong this REIT is. And also another thing why REIT could be well positioned for the future, if because we are going to the inflationary environment, the Vici is best positioned to absorb this inflation, because the Vici continues to increase the rent with inflation. So in this case, you will not be really losing money on inflation if you're investing in Vici Properties. Vici has the dividend yield north of 6%, and this dividend yield continue to increase as the Vici stocks continue to go down. This stock you see is bottoming every time it's hitting around 27, so probably we can start opening the position at 27, and if it's going lower, we can dollar cost average down. If you want me to do the video on the channel where I am doing the fundamental analysis of any stocks in the list, or for example stock in your watch list, please let me know in the comments below. And if you're curious how I do stock analysis, please watch this video next. I explained how I boosted my productivity, and now I do stock research significantly faster using cutting edge AI tools. See you there.